As we all know, due to inflation, prices for almost everything has gone up. One recent report shows that fuel prices are up 65%, eggs are up 49%, airfares are up 36%, and look, don't get me started with real estate prices. And usually the IRS adjusts tax brackets every year, but even they've made some bigger changes for 2023, which should give relief to millions of American taxpayers. So in this video, what I want to do is go over some important 2023 tax updates, such as the new tax brackets, the new standard deduction amounts, some capital gain thresholds, and other important updates that may impact your 2023 tax return. Let's go ahead and get started with number one, new tax brackets. All right, so here in the United States, we have what is called a progressive tax system, which basically means the more income you make, the more you're going to be taxed. So when tax brackets increase, then it effectively lowers everyone's federal income taxes, unless of course you're making a lot more income, which is super helpful, right? Like with all of this inflation, at least we may be able to pay less in taxes. So let's go ahead and look at the numbers. For individuals who make less than $11,000 per year, they will fall into the 10% tax bracket, which after the standard deduction may give them an effective 0% tax rate, but more on that a little bit later. Now, for individuals who have income between $11,000 and $44,725, you'll be taxed at a marginal 12% tax rate, which is an increase of $725 from last year. For individuals who have income between $44,726 and $95,375, you'll be taxed at a 22% marginal tax rate, which is an increase of $2,950 from last year. And most middle-class taxpayers are going to fall somewhere between the 12 and 22% tax bracket. However, for individuals who have taxable income between $95,376 to $182,100, you'll fall in the 24% tax rate, which is an increase of $6,300. And for those with incomes between $181,101 to $231,250, you'll be taxed at a 32% tax rate, which is a $12,050 increase from last year. Income between $231,251 and $578,125 is taxed at a 35% tax rate, which is a $15,300 increase from last year. And finally, all income above $578,125 is taxed at a 37% tax rate, which is an increase of $38,255 from last year. Now, if you're following along, then you probably noticed some very interesting trends here. Well, a couple of things. Number one, individuals who made more income saw a bigger dollar increase to their tax bracket from last year. And then number two, across the board as a percentage of income, most tax brackets have increased about 7%. Now, before I move on, if the progressive tax system is still a little bit confusing to you, then I have a video called Taxes for Beginners where I walk through a very thorough example with math and calculations. I'll go ahead and link that video at the end of this one if you want to check it out. Okay, now what about married filing jointly statuses? How have their tax brackets changed? Glad you asked. Let's get into it. Well, generally, you can take individual tax brackets for 2023 and multiply it by 2, since basically it is 2 individuals, but they're married in the same household. And you'll get the same increases for the tax brackets. For example, a married filing jointly couple with less than $22,000 will be in the 10% tax bracket, doubling that $11,000 for individuals. Or for a couple with income between $22,001 to $89,450 will be taxed at a 12% tax bracket, doubling the upper limit of $44,725 for individuals. The only exception here is for people in the 37% tax bracket with a married filing jointly status, because instead of doubling their individual tax rate, it only increases $693,750. So when you are a super high income earner, then it really does pay to be married. All right, I'll go ahead and throw up on the screen the 2023 tax bracket changes for all the filing statuses, and you could pause the video here if you want a closer look. All right, now what's the key takeaway with all of this? Well, the IRS pretty much raised tax brackets around 7% in an effort to combat all the rapid inflation throughout the United States. So what do you think about this? Is this a good enough solution to combat the inflation? Tell me down in the comment section below. Now, the IRS has done a couple of other things, so let's go ahead and talk about that with number 2, new standard deduction amount. So of course, every American taxpayer is entitled to what is called a standard tax deduction, which is a specific amount that the IRS issues every year that is given to you, and the amount of your standard deduction depends on your filing status, whether you are filing single, whether you're filing married, filing jointly or separately, whether you're filing head of household, and so on. Okay, so the new standard deduction amounts for 2023 are $13,850 for single filers, which is the increase of $900 from last year, $20,800 for head of household filers, which is an increase of $1,400 from last year, and $27,700 for married filing jointly statuses, which is an increase of $1,800. So for example, very simple example, if you are single and you earn $100,000 in income in 2023 and you use the standard deduction, then your taxable income would be $86,150. Now you should know you can choose to take the standard deduction or use Schedule A of the 1040 form and itemize your deductions to get an even bigger tax deduction. However, in general, you would only want to itemize if the amount of your individual tax deductions exceed the standard deduction amount. Otherwise, it doesn't really make sense. All right, so for all my real estate investors and those who like to invest into the stock market, let's go ahead and talk about number 3, new capital gain tax brackets. Because when you have a capital asset like a rental property, for example, and it appreciates in value and you sell it, what are you going to have? A capital gain. Now, you need to know that there are short-term capital gains and then you have long-term capital gains. Short-term capital gains and losses occur when you sell an asset within the first year of acquiring it. And when that happens, your gain is treated as ordinary income and you are taxed at the same tax brackets that we covered in point number 1. On the flip side, long-term capital gains and losses occur when you sell an asset you've held for more than 1 year. And the tax rates for long-term capital gains remain unchanged, ranging from 0% to 15%. However, just about every year the income threshold changes, and I'm seeing about a 7% increase from 2022 to 2023. I'll go ahead and put up the tax brackets for capital gain on the screen, and you can pause here if you need more time. So if you are big into stocks or you're a real estate investor and you plan to sell some assets in 2023, then you definitely can benefit from this. But honestly, investors, especially real estate investors, have many ways to leverage the tax code than just relying on IRS adjustments. You should definitely have a tax plan, which, by the way, if you need help with tax planning or tax preparation, then you can schedule a call with our team by clicking the first link down in the description below to learn a little bit more about how we can help you. Now, if you are a business owner, I want to quickly talk to you about number 4, positive tax changes affecting business owners. So if you are someone who uses your vehicle, your car, your SUV for business, then you have the ability to write it off using the standard mileage rate. This is a rate that the IRS issues every year that allows you to write off a certain dollar amount for every business mile you drive. And in recent years, the mileage rate has actually been going down. In 2019, it was 58 cents per mile. In 2020, it was 57.5 cents per mile. And in 2021, it was 56 cents per mile. But in 2022, the IRS revised the rate due to inflation and increased it to 58.5 cents per mile. And now in 2023, the IRS has made a huge shift, giving business owners the ability to write off 65.5 cents per mile. Meaning, if you drive 10,000 miles for business using the standard mileage rate, you can write off $6,550. This is the biggest increase that we've seen for the standard mileage rate in a very long time. And in addition to those mileage increases, business owners will also experience an increase in fringe benefits for transportation and parking, higher contribution limits for medical saving accounts, and higher contribution limits to some retirement accounts as well. So these are some of the things that you want to look at and maybe incorporate as you make your tax plan. All right, now let's go ahead and answer a very big question with number 5. How will all of this impact you? So here's the thing, okay? Yes, the IRS has made some adjustments and bigger thresholds. However, the tax law is changing all the time, and there are some major cuts being made as well. Okay, on the individual sides, we're seeing downgrades to things like the child tax credits and dependent care credits. Also, charitable donations have been limited. And of course, there's no more stimulus payments being added during your tax time. And on the business side, what we're seeing is bonus depreciation is being lowered from 100% to 80%, and meals and entertainment deductions are no longer 100% deductible. And in fact, the IRS has already came out publicly to tell Americans to expect lower tax refunds in 2023. So depending on how you make your income and the amount you make, some of these changes may work in your benefit and some of these changes may work against you. For example, in theory, everyone should be paying less taxes as the brackets increase. But if you lost a key tax strategy like bonus depreciation, then you could end up paying more taxes than you ever had before. Plus, at the end of the day, tax deductions give you some relief, but it's still all about how much money you make and keep after taxes and all your expenses. Look at it like this. Let's say in 1 year you made $100,000 in income, paid $24,000 in taxes, and had expenses of $50,000 like your rent, your groceries, utilities, insurance, gas, so on. Well, in that case, your total take-home pay would be $26,000. Now let's say in another year you made $103,000 because you got a 3% raise, but you paid $20,000 in taxes thanks to the IRS cuts, but then your expenses went up $60,000 due to inflation. Then in that case, your total take home will be $23,000. So yes, even though you made more income and you paid less in taxes, inflation still wins. But of course, everyone's situation is a little bit different, and some people have a strategic tax plan that allows them to avoid many more taxes. Okay, now if you like the video, please do me a favor and actually like the video for the YouTube algorithm and subscribe for more great content. Coming up next, I have 2 more videos you may enjoy as well, so check those out if you haven't already, and I'll see you over there.